Well, it's been a great conference so far, I think, and I'm very happy to introduce our next speaker, Dan North. I've heard Dan speak a number of times. Dan North is the senior economist for Euler Hermes ACI. Euler Hermes ACI is the largest provider of trade credit insurance, where Dan helps manage the company's risk portfolio. Dan has appeared on CNBC, Fox Business News, Bloomberg Radio and Television. He's widely quoted for economic forecasting. I have a story. I was with the Euler Hermes rep here in Utah once in the beginning of 2008, when the economy was just thriving. And he says, our senior economist says there's going to be a correction. I'm thinking, oh, unfortunately, Dan was right. And in fact, he is rated by Bloomberg as the top 65, as the number 4th in the Bloomberg list of top 65 economic forecasters. And so he will forecast here today about the domestic economy. So please join me in welcoming Dan North.
Thank you, Mark. Thank you very much. Can you all hear me? No? Can we turn up the volume? There we go. That's much better. Thank you. First of all, thanks very much to ZionsBank for having me. It's really a privilege to speak to a room that's got this many people in it and to follow up two terrific speakers. I thought they were really great. In fact, when I was first asked to speak here, I said, please let me have the first slot of the day. Let me have, whatever you do, don't give me the slot just before lunch. Because by this time, people are hungry, the speakers get boring, and in addition to that, I now have two great speakers to try and match. So I hope I can. I'm here to talk about the state of the U.S. economy. I'll speak for about 35 minutes, and somebody took my notes. That's sorry, that's like 11:30, right? Something like that. Okay. So I'm here to speak about the outlook of the U.S. economy, and really I think the outlook, generally speaking, is pretty positive. There's some risks, but it's generally pretty positive, and I'd like to see how many people agree with me that it's mostly pretty positive. Yeah, okay, so I've got a few to convince here. We'll look at the forces acting on the economy and the measures of the economy. We'll look at the government responses, which now constitute risks to the economy. And then we'll look at energy in the future, and then we'll come to our conclusions. Now, to come to the conclusion that I do, that things are pretty good, I think it's useful to look at the four things that took us into and out of the recession and what they're doing now. There are four forces which started and ended the recession. There's oil, the housing market, Fed policies. Actually, those first three started the recession. The fourth one, fear in the credit markets and the financial markets, didn't come until about 9 months later. But these are the things that started and exacerbated the recession. Now, before we go any further, I just want to define this term at the bottom, GDP, gross domestic product. If you think of the U.S. economy as one big factory, one giant factory, everything that comes out of that factory, everything that's produced by that factory, it's a product of that factory, is what GDP is. It's about $14 trillion a year now. And on average, it grows about 3.3% since the end of World War II. We'll use GDP actually right in our very first analysis, the very first chart, also looking at oil prices. The black line is growth in GDP, and you can see when it goes negative, goes below zero, conceptually, that's when we have a recession. The yellow columns are spikes in oil prices, and the point of the chart is when you have big spikes in oil prices, they're usually associated with recessions. So for instance, there in 73 and 74, all the way at the left, at the Arab oil embargo, prices spiked 290%. They went from $3 a barrel to the then unthinkable $11 a barrel. That'd be like for us going to $400 a barrel, so you can see that would be a pretty big shock. And it led to the recession here. And then we had the second energy crisis, where we had energy prices spike 140%. Which led to that double dip recession there. And we had more spikes as we got involved in the first Gulf War, leading to a recession. And then over here, we got some spikes. And the black line there doesn't go all the way below zero, but this is annual data. Trust me, if it were quarterly data, you'd see it negative below the line. I just have to tell you that you trust me that there's a recession there. And then in 2008, oil prices spiked 36%, surely leading us into the Great Recession, that black line going down. Well, next year, oil prices fell dramatically. Oil prices fell 36%, and as sure as high prices drive you into recession, falling prices can help you back out. And that's where the black line, the economy, GDP, starts soaring, starts going up. I'm going to show you now what's happening now. First of all, I'm just going to show you 2010, not 2011, but 2010. See the growth rate in oil prices in 2010. I don't like that very much. I don't like the size of that spike because it's a big headwind on the economy. It's not enough to derail the entire economy, not enough to derail. There's too much other good stuff going on. But to me, it's the biggest single risk out there. In fact, the two things that I don't like the most, I'm going to show you first. Oil prices and the housing market. In the housing market, there's nothing good to say. I've been looking for so long for something to say positive about the housing market through all the data. It's not there yet. There's nothing positive to say about it. But it means that we've recovered without it, which you usually can't do. So when it does come back, it's going to be great. It's going to be a nice boost. The other point to make is it's an incredible buyer's market, which is a precursor to having the market pick back up. And we can look at that by the Affordability Index. The Affordability Index, when it's at 100 at that black line, that means that the median income can buy a median-priced house on an 80-20 mortgage. And when the yellow goes down, like here in the 70s, there we go, we had mortgage rates of 18% here. So affordability obviously went way, way down. And then in the 90s and the 2000s, we had easy credit, low interest rates, so affordability went up. But there towards the end, right before where it says the housing bubble, oops, housing bubble, there. Okay, back again. Just before the housing bubble burst, prices on houses rose so fast, so high that affordability fell. Then the housing bubble burst, prices collapsed, and of course affordability rose. Prices have collapsed completely. They're still falling, and we have very low historical interest rates. Affordability is at a huge record high. So this is a nice precursor for a rebound. You have to have this, and we have it big time. So those are the two things I don't really care for much. That's a good thing I like a lot, which is the Treasury yield curve, this black line. It's the difference between the yield on the 10-year Treasury note and the 3-month Treasury note. 10-month up here, the 3-month down here. So you can see, for instance, I'm going to go over here, these folks evenly here. So the black line is the difference between the 10-year and the 3-month. And right here, for instance, you might have 300 basis points. That'd be where the 10-year was at 400 basis points and the 3-month was at 100 basis points. The difference, that gap, is 300 basis points. And you can see it changes over time. You can also see sometimes it goes negative. That is, short-term rates become higher than long-term rates. And that's where the yield curve, the black line, goes under zero. We call it the negative or inverted yield curve. Why is this important? Because it's a really good indicator of a future recession. Let's compare it to GDP. You see here we had the negative yield curve here in the early 70s, followed by a recession. Negative yield curve in the late 70s, recession. Negative yield curve in the early 80s, recession. Didn't have to go all the way to negative here, recession. Negative here, recession. And in 2007, the yield curve went negative, surely forecasting the Great Recession that we went into. The yield curve is a very strong indicator. But look where the black line is now, up around 300 basis points. That's high. That's high. That's a really nice thing. It gives me a lot of confidence about the economy. Because just the way we did this trick with the negative yield curve, we can do it with the positive one as well. When the yield curve goes positive, like this, it's followed by a recovery here. The yellow goes up. Yield curve positive, yellow goes up. Yield curve positive, yellow goes up. Yield curve positive, up. Yield curve positive, recovery. Yield curve positive, surely taking us into the recovery we have now. And where it is now, forecasting 6 to 9 months, something like that, into the future, saying the economy is going to continue to grow. So I really like that one. The other thing that I like is during the recession, there was credit markets dried up. Credit markets and the financial markets and the banks dried up completely. And only up to now, only right now, banks are actually starting to lend. You can see that here. This is the growth in commercial and industrial loans. You see that last little pyramid to the right, that's growth finally going positive. Banks are actually starting to lend instead of just saying they're going to lend. This chart also helps explain why a recovery has taken so long to come out. If you look at the very first recession all the way on the left, you can see that loans shrank to a certain extent. If you look over here in the double dip, loans didn't shrink at all. In the 90s they shrunk, in 2000 they shrunk some, but we plunged. We absolutely plunged. And you can't grow an economy unless you have credit expansion. Now we're finally getting it. So that's really a great thing. So let's recap for a second. Now the four forces caused us to go into recession, brought us back out. Oil's still bad, housing's sort of a negative, the yield curve is great, and the lending is good too. So what are the measures of the economy? What does the dashboard say? Well, it's pretty good. Here's gross domestic product again. You can see all the way on the right, we've had 7 straight quarters of positive gross domestic product, and it has been anemic, that's true, but positive is so much better than negative. People take it for granted. When you look at all that yellow down below the line, that was a bad time. That was a bad time. Things are so much better now than they were, just not as strong as we would like. And we forecast into the next couple of years GDP growth of something like 2 to 3%, still not terribly fast. It's interesting to look at this chart. You see the recessions. The one all the way on the left was the double dip recession. If you kind of squint your eyes maybe a little bit, look at each side, you might kind of see that maybe there's more yellow on the left, maybe not. The point is, this might not have been the worst recession in our time. Yes, unemployment's still high, and that's important, but that was a bad time. That was a really bad time, and we came out of that too. Most important part of GDP is the consumer. The consumer, of course, these are retail sales, fell right off the cliff, right off the face of the earth during the recession, but have come back pretty strong now. In fact, real retail sales, I can't see the numbers, something like 6.5% versus 2% long-term average. Great. How about the manufacturing side? This is the Institute of Supply Management survey, which I know you all follow very carefully, the Institute of Supply Management. Us economists like it a lot. The black line is it's the yellow line. Basically, when these lines go above the 50 level, it means things are expanding. And the yellow is the overall manufacturing. You can see it's substantially above 50, indicating good activity in the economy. The black line is the employment component of this survey. And you can see that it's the highest it's been since 1973. Very, very positive there. So we've got a good consumer, good manufacturing, which leads us to good corporate profits. The yellow are the quarterly increases in corporate profits, much more positive than they were. It used to be negative. The black line is the annual year-over-year rate, and it looks like it's going down, and it is because we're having more and more difficult comparisons because last quarter was stronger. But it's still at 20%. That's a really high growth rate. So we've got good corporate profits as well. So I can tell you everything's great that I see. Consumer's great, manufacturing's great, got good corporate profits. But there's one thing that's still not great, and that's the employment situation. The first Friday in every month, at 8:30 in the morning, comes the employment report. And it's by far the most carefully watched report for economists and market participants. So when 8:30 comes, everybody's in front of their screen. And there are lots of numbers in this report, but the two most important ones are this. The black line is the unemployment rate, currently around 9%. I think it's peaked at 10.1% last October, or a year ago October. And the yellow is the number of jobs created or lost. So you can see we lost an enormous amount of jobs. But we've been creating jobs for, I don't know what it is, 15 months, something like that. It's been anemic. It's been slow, except for the last 3 months. The last 3 months have been great. Not as great as we'd like, but they've been great. It's the best 3 months in 6 years. So I think employment really is starting to getting traction. As I say, it's been anemic so far. I'll show you how many of the jobs we've erased. It's a fair amount. We've erased a lot of the jobs, just not enough. We've got a long way to go. So let me recap once more. We saw the four forces take us into and out of the recession. Oil's bad, housing's negative. Yield curve's great, lending's good, GDP is okay, consumer, manufacturing, corporate profits are great, employment is catching, But the unemployment rate is still high, and to try to fix that, the government is actually causing two more problems: debt and inflation. Trying to fix it, and they're making it worse. Nobody's really surprised about that. Let's look at fiscal policy and monetary policy. Fiscal policy is first run by the Congress administration, where they deal with spending, taxing, borrowing, deficits, debts, and budgets. Now, there's a lot of talk about budgets in Washington now, so it's a little confusing. First was the Fiscal Deficit Reduction Commission, which finished up last year, which made some really great recommendations, plenty of shared sacrifice. And then came the Obama 2012 budget, where it was his commission, but he took almost none of the suggestions of the Fiscal Deficit Reduction Commission. We have continuing resolutions, because there was never any 2011 budget. Every once in a while, the government has to resolve to continue running. And the last time, the Republicans said, oh, we're not going to do that unless we get spending cuts. We're going to do that again in a few months. Then there was the Ryan 2012 budget, the House Republican budget. Obama 2012 Part 2, which was basically just a scathing rebuke to the Ryan plan. There's the Senate gang of 6, which is now down to 5, and losing altitude rapidly, it looks like. Then there's the Biden commission. Since the president didn't like his first commission, he's come up with a second commission, and since it's his vice president, I think he's going to get the answer he wants this time. Then there's the 18% budget, which came out of the House as well, which basically says revenues are 18%, have been forever, so let's just cap spending at 18%. But here are the results of all that. All those have failed one way or another. Fiscal Deficit Reduction Commission has been kind of kicked around. Obama 2012 was voted down yesterday in the Senate. Continuing resolutions, we're going to have more of that. The House Republican plan was voted down yesterday in the Senate. Obama 2012 Part 2 never really had any specifics behind it. The Senate gang of 6, as I say, is kind of losing altitude. You have the Biden commission, and the 18% budget is pretty much gone. I see in the paper, because the Ryan budget lost, they're now coming up with yet another plan in the House. So there's a lot going on in the budgets, and it's important to know when you look at budgets how budget math works in Washington. It works like this. Let's say you're an agency in year 1 and you spent $80. And then you make a budget for year 2 where you want to spend $110. And you have your budget negotiations, and the final amount you have is $90. Now in Washington, even though you're spending more this year than last year, this is a $20 budget cut. This is how I'm serious, this is how it works all the time. Your budget went down from 110 to 90. You wanted to spend 110, but you can only spend 90. You suffered a terrible $20 budget cut. Both sides do this. They do it all the time. If you hear about budgets being cut, deficits being cut, spending being cut, you got to ask from what? You know, because they could make up any sort of plan. So this is budget math, and that leads us into deficits. And here's how a deficit works. The government spends $120, let's say, but only gets tax revenue of $100. And that makes a shortfall, a deficit of $20. So how do you plug that hole? Well, you call up Tim Geithner over at the Treasury and say, Tim, I need $20. Go get me $20. So Tim and the Treasury issue $20 worth of notes and bonds. That's how the deficit gets plugged, by issuing Treasury bonds, by borrowing money, us borrowing money. The Treasury is doing it for us. When we speak about debts and deficits, it's hard to get your handle around how big 20 trillion is. It's really, you don't really know. But if you measure the size against the economy, the GDP, it starts to make sense. Here's the record on budget deficits, and you can see that almost all the time we run a budget deficit. Rarely do we get a surplus. And this is the record from 1960 up until recently. The average here has been, spoiled my surprise, the average here has been 2% over this period, similar to other industrialized nations. The most it's ever been is 6% up until now. That's what happened as the financial crisis. We've had 3 years in a row of 10-ish% plus deficits. And it's clearly we're operating in a different mode. Now, the problem with deficits is, I'm going to take these columns and flip them up in the next chart so that I can show you as the deficit gets worse, starts getting bigger, interest rates get bigger too. The black line, the yield on the 10-year starts going up. And it makes more sense. You want to borrow more money, the price of the money has to go up. And it also works the other way. Fewer deficits, less deficits, falling interest rates. So if you see those giant columns to the right, and all the mass out on the right still going out, you could expect rising interest rates. And that's what that little curve in the bottom, that black line, that's what I think. I really do think interest rates are starting to rise. So all these budgets, all these deficits accumulate into debt, of course. And here's the record on the debt. This is from the 60s on. Our debt has been something like 63% of GDP until now. That's what's happened with the financial crisis. Now, there are a couple problems with this chart that are, first of all, while I'm thinking of it, you know, in the very first speaker this morning, Ms. Blank started talking about emerging markets and how they're growing fast and that sort of thing. That's right, emerging markets are growing really fast, much faster than us. One of the reasons, their debt level is about a third of ours. A third of ours. Those little countries that had fiscal, you know, not very good fiscal circumstances a few decades ago, now a third of ours and growing very fast. The other problem is, you see up there, when you get debt levels above 90% of GDP, you start losing about 1% of GDP. Well, that would be like running in place for us. That would be really a serious detriment. But the scariest number to me here on this whole chart is all the way down in the lower right corner, that 2012, where's my, that 2012 right there. See, this is the budget plan that's in place. This is the plan that's in place. Look, debt is going up for the plan, not down. There's no credible effort there in the Obama budget to lower deficits at all. So he knew this was a problem. That's why he appointed the Deficit Reduction Commission. And they finally said the thing that politicians have been avoiding for so long, which is this: we must touch the third rails of Social Security and Medicare, particularly Medicare. If we don't reform those, we'll never get a balanced budget. Those entitlements will become the whole budget. The rest is just whistling past the graveyard. What I mean is this. Here's the 2009 budget. The numbers aren't so important, but look at the orange piece of pie here. That's mandatory spending, which is jobless benefits and welfare. Here's Medicare and Medicaid, Social Security. By the way, mandatory spending means it will be spent. You will spend. It's on autopilot. It's going to be spent unless you reform the programs. So those big three pieces there are all mandatory spending. Defense spending, you know, it's somewhat discretionary. TARP, that purple is gone, so let's not worry about that. Interest, you got to pay the interest. So that leaves you that little piece of blue pie at which to whittle away on the deficit. Now, a couple weeks ago, as I mentioned, there was huge negotiations about shutting down the government, and the Republicans managed to win these terrific budget cuts that were just, you know, really heroic. And if you look at that piece of blue pie, this is what they got. Now the budget plans that we just saw generally are planning to cut a lot more than that for 10 years going forward. It's tough. It's tough to see how it will happen. It can, but this shows you what we're up against and how this works. In the meantime, Treasury's issuing Treasury bonds. That's the Treasury issuance over, I don't know, up until now. Here's what happens after the financial crisis. That's a different mode of operating. That's a different mode of operating. Those are Treasury bonds that are being borrowed. And by the way, for your information, yesterday, the Treasury indebted you for, what is it, $35 billion of 5-year notes and $29 billion of 7-year notes. That was yesterday. Treasury did that on your behalf. They borrow money all week long, all throughout the year. Black is where the Federal Reserve has been buying Treasury bonds over the past 7 or 8 months. And in this program, QE2, which we'll talk about, the Fed's going to be done next month in June. They're saying it's very clear we're not going to be buying any more Treasury bonds. So that biggest single buyer in the whole market is going to be gone next month. And it makes me think bond prices are going to fall and interest rates, again, are going to rise. Let's see. What's next here? So that's fiscal policy. Let's look at monetary policy. We were just talking about the Fed. Monetary policy works. That's what the point of this chart is. And if you just go along with me, take a leap of faith, monetary policy is pretty effective. The yellow line, the Fed funds rate, is directly controlled by the Federal Reserve. And you can see when it moves up or down, other interest rates do as well. And it has a very strong influence on the economy. So monetary policy, the Fed funds rate, Short-term interest rate works. This time we needed an extra boost. We needed to lower long-term interest rates as well. That's when we went into this program of quantitative easing. And the way quantitative easing works is the Fed prints new money. Now, printing money sounds like something sinister or pejorative. That's what the Fed does. That's part of their job, is to print what they think is the right amount of money. And right now they think it's a lot. So you print new money. You go out in the open market to buy treasury bonds. You raise bond prices because you're buying a lot of bonds. That lowers interest rates because they move the opposite way. That puts money in the financial system. When you go to buy a bond, you give money over and it goes in the financial system, and it creates inflationary pressures. The record, the central tenet, of economics is inflation is caused by too much money. And let's look at the record here. The black is the growth in the monetary base, which the Federal Reserve controls, and the yellow is the inflation. Now, you can see here in the 30s, you see there are 3 spikes there in the black. Every time there's a spike in the monetary base, that is, too much money comes into the economy, you get a rapid increase in inflation. Spike here, rapid increase in inflation. Spike here, rapid increase in inflation. Didn't get so many spikes after World War II. Things smoothed out a little bit, but I should tell you that when you get spikes in the monetary base, you're going to get inflation. So maybe this might make you concerned. This is what we're doing now. That's a big spike, isn't it? What this is, what I call QE1, was when we were in the middle of the financial crisis, all the markets were melting down, bond market, stock market, everything was getting very scary. Ben Bernanke came out and he said, everybody, just take it easy. Take it easy. Because you see, I've got a bank. I've got the biggest bank in the world. I've got so much money in this bank that nobody will ever need to fail again. I've got the biggest printing press in the universe in my bank. And I'm turning it on. And that's what that black that spike is at the end there. And it worked to a certain extent. The S&P went up 8% in a couple days. It's probably the right thing to do. Another way to look at it is this yellow line is what we call the balance sheet of the Federal Reserve. Again, it's just another way to measure how much money is in the reserve. You see the first spike, that's that QE1, when Ben came out and said, everybody calm down. And you can see where QE2 started. We'll talk about QE2 here. The idea behind QE2, which again was to buy bonds, raise prices, lower interest rates. So when you engage in QE2, you're hoping to lower long-term interest rates. Now, this is the yield on the 10-year note starting approximately last year, and it was on the way down because the economy was weak, and it was sensing also inflation was getting weaker and weaker. So every August, the Federal Reserve has a retreat just up the street here in Jackson Hole, and at this retreat, Ben Bernanke came out and he said, you know, the economy's not doing as well as we'd hoped it would. We're thinking about maybe doing that quantitative easing thing again. That's one of the tools we could do. And then at the next meeting of the bank, he came out and said, you know, that quantitative easing thing, we're thinking about that pretty hard. And then in the November meeting at the bank, he came out and said, yes, quantitative easing, that's what we're going to do, $600 billion worth of treasury bonds over the next 8 months to lower long-term interest rates. That's what he hoped for. Here's what he got. He got, over the first couple of months, a record rate of increase in interest rates and inflationary expansion, a record rate of increase. It's come off a bit since then. But what happened here? Well, the bond market is pretty clever at stiffing things out. And they said, basically said, Ben, we see your plan. You want to buy bonds, but you're buying it with new money. That always causes inflation. So when there's a lot of inflation, interest rates go up. So the bond market wasn't fooled. And we got a little derailed there with Egypt and Libya and Japan. And we had a little downturn recently, but I really think that this is the long-term trend you're going to see. I really think interest rates are on the way up. Inflation, quantitative easing, printing money, they're all the same thing as dollar devaluation. So we just saw quantitative easing, dollar devaluation, all the same thing. So quantitative easing, again, is meant to stimulate the economy by lowering interest rates, but it also do a couple different things. It can devalue the dollar, and it can devalue the debt we owe. We owe $4 trillion to foreigners. It can raise commodity prices, which is inflation. It can also lower the trade deficit and create asset bubbles, but I'm not going to talk about those two here. I just thought I'd list them. So let's look at the devaluation of the dollar from QE2. Every line is the value of the dollar versus a major currency over the past year. And you can see all the way down on the bottom, the currency, the US dollar has fallen, what is it, 24% against the Swiss franc? And the next is the Aussie dollar, fallen 21%, 13% against the euro, and so forth and so on. And Bernanke's throwing money into the world economy. Every time you throw dollars in the world economy, those dollars become worthless, worth less, I should say. Well, this is actually kind of a good thing in some ways, because we owe $4 trillion, and we can devalue debt like this. Another example, today, let's say you lend a dollar at 10%, and a loaf of bread costs $1. Inflation overnight goes to 20%. A year later, you're the creditor, you made a good loan, you got your $1.10 back, but now a loaf of bread costs $1.20. Creditors lose with inflation. Debtors, like the US government, win big with inflation. The US government's okay with some inflation. They're okay with the weaker dollar. Geithner will come out and say, oh, strong dollar policy. But he'll say it like that, strong dollar policy, with his head down. Really, it may be the only way out of getting all the debt we owe. And I think dollar devaluation could be going on for years. Now, oh, yes, we also said dollar devaluation can raise commodity prices. The way this chart works, did I do it this way? Yeah, this is better. The yellow is the dollar getting weaker. I have it plotted so when it goes up, it's getting weaker. And you can see over the last years, the dollar went weaker. Those two lines went up. The black line is oil prices. Oil prices up 40%, I think. And commodity prices, the other line, a basket of commodities up 45%. Pretty strong relationship. This is inflation. Commodities are rising. Commodity prices, that's inflation. So I think we see some inflationary pressures in the economy. And speaking of oil, this will be sort of my almost last topic. Let's talk about energy and oil. And I want to make the point that I think is right, of course, that there's no such thing as a safe, riskless source of energy. It does not exist. Low probability of an accident, like an oil well blowing up at the bottom of the ocean, very, very low probability of happening. But it's not zero. And it means it will happen with certainty. So since there will always be risks with any source of energy, just pick your favorite, but no, it's not safe. There's no such thing as completely safe. For instance, nuclear, you have the risks of radiation and waste. Coal, you have toxic emissions, greenhouse gases. Mining is very dangerous, kills a lot of people every year. And it's thought that coal emissions kill 30,000 people a year in this country, compared to zero in Fukushima. I mean, the guys that worked in Fukushima are a lot of them are going to die, but outside of Fukushima, 0 people so far with radiation poisoning. So which is worse? Natural gas, extraction harms the environment, costs for conversion. Renewables are great. Absolutely have to have renewables for the long term. The problem is they're not going to be able to develop enough, fast enough to keep us, to meet our needs. And there's visual pollution involved with those too, all these big solar arrays. Oil, of course, there's spills, emissions. And to me, the biggest risk on this whole chart is dependence on foreigners. That, to me, is the biggest risk there is. We really should have our own oil, because here's how the world's going to change. This is 2009, roughly now. The U.S., this is GDP, global GDP. The tan is the U.S., and you can see we're 25% of the world economy, 5% of the world's population. We're in a very privileged situation at the moment. The next largest single countries are Japan and China, both around 8 or 9%. China's a little bit bigger now. And if we step forward 40 years, let's see what happens. Changes in the world GDP. Watch that tan pie. That's U.S. GDP as a share of the globe 40 years from now. Let's go back. Watch the yellow and the red, that's China and India. Watch what happens with them. That's what's happening. You have 8 times as many people growing. Their economies are going to be bigger. Here it is side by side. It's not a matter of mismanagement. It's not like we're messing something up. Just think of it this way. If you go back to your office and you find 8 guys sitting in your office, are they going to be able to outproduce you? Yes, of course they are. It's not mismanagement. And some of the implications are this: we do need our own oil. I really think so. Protectionism is no longer going to be an option. We should teach our children Chinese and Hindi instead of Spanish and French. That is good. Those are going to be the business languages. And we need to have really strong relationships with China and India. It's not doomsday, though. I never believe the doomsday case. It's not doomsday. It doesn't mean the end of our prosperity or freedom or global importance. It does just put us at risk of growing credit, growing foreign creditors. Puts the dollar at risk as being the reserve currency. And it puts us at risk in not having enough oil as we go forward. So those are my thoughts. Oh, those are my thoughts. That's the conclusions here. On the left are the positives. The strong consumer, strong manufacturing, employment is catching, strong corporate profits. Tax package last year was helpful, I think. Fiscal debate might help. Monetary policy is going to take off, in my belief. Banks are starting to lend, really a great thing. Falling dollars is helpful in the short term, and then a positive yield curve. You got to like that. That's a really strong indicator. The risk, of course, oil prices is the biggest risk. I have the weak housing market. Again, we've gotten along without it so far, but we'd really like to have it back. We do have high unemployment still. Inflation, I think, is on the way. By the way, I'm making a strong argument for inflation. I'm not arguing that inflation is really going to blow us out of the water, but I do think we'll have inflation. Fiscal policy has been damaging. We've got problem in the state budgets, and we have the pigs, Portugal, Ireland, Italy, Greece, and Spain, which continue to cause us worries from across the pond. Just keep in mind, there's no choice of energy that's safe. And the U.S. is not going to be the largest economy forever. So thank you for your attention very much.
We'll take questions there.
Thank you, Dan. We have time for a couple questions, and if we could get those microphones back up here. And with me is Craig Peterson, who's the Director of Trade and Diplomacy for the state of Utah in the Governor's Office of Economic Development. I'm going to have Craig ask the first question.
Thank you for your very insightful presentation.
My pleasure.
I'd like to talk a little bit about oil prices. The administration has called for the elimination of tax incentives for domestic oil production. What is your view? Is that counterproductive based on your presentation?
If you take tax incentives away, you're basically raising taxes on an organization. There was some sort of unbelievable connection trying to be made that if we raise taxes on oil companies, it will lower gasoline prices, which I found kind of a remarkable idea. If you expect when you raise costs on a business that they're going to lower their price, doesn't seem to work. So anytime you have a change in taxes, whether it goes up or down one way or another, it's going to get floated through to the consumer. It is. There's really no way around that. So I don't think it's necessarily terribly effective either way. What would be effective is making sure everybody got treated the same way, and rates would be lower, hopefully.
You mentioned Washington, D.C. math budget. Okay, reminds me of the budget we have in our home. When you calculated that, by the way. Couldn't the answer simply be, and maybe help us explain this, which is discussion, a cap on the debt limit? Is that the answer?
I get this one now. Okay, I have that one back. Well, in the short term, you have to have the debt. You have to raise the debt limit, whether they like it or not, because you can't bring the government to a grinding halt, and you can't default on your bond payments. That would be disastrous. And the Republicans know this, and I think the chances of actually defaulting because you didn't raise the debt ceiling are awfully, awfully small. So the idea is, you try and keep things moving as you can now, and then come up with a credible budget. Hopefully, there'll be a bipartisan budget at some point that keeps the debt level under control. That would be the ideal state. But for now, you can't stop. But you got to make a long-term plan.
Another question that's submitted: what other industry sectors do you see opportunity to grow? maybe outside of oil and housing?
Let's see. High tech is always good. The U.S. is very good at developing high technology products. It's one of our strengths. Manufacturing is actually rebounding nicely. But we're come from a credit shop, so we think about what can go wrong instead. So we still don't like autos terribly much or anything involved in transportation because of higher oil prices, that sort of thing.
In connection with that, gold has recently hit a new record. Should we be buying gold based on the devaluation you presented?
I'm not permitted to answer investment questions or give investment advice, but I'll try. If you expect to see dollar devaluation, which is the same thing as inflation, the classic hedge is gold for sure. But gold has run a long way really fast. So, commodities markets, bond markets tend to sense these things ahead of time. So it's entirely possible that the inflationary expectations have already driven up gold to, levels at which they're not going to go a lot further. But I don't know that for sure. It's hard to say. Markets price in information, so I don't know if it's priced it in or not. If you're worried about inflation, gold is a good place to go.
Dan, you mentioned that jobs are catching up. This comment was, many lost jobs are high-paying professional jobs. Are the new jobs true replacement to those high-paying jobs?
Who said that?
Some guy wrote it.
Oh, he did? Let me see that. Next question. Well, that's often a concern, is that, high technology, high value-added jobs go away, and then we're left with a workforce that doesn't have the educational skills to try and fill that. That's always what happens. That's what happens in every recovery. So I'm a little less concerned about that than I might be. It's that's kind of the way the world works on that. When you lose jobs and lose skills, eventually they get filled back up. So I don't see anything that's terribly different there than most recoveries.
Well, on that, maybe this will be our last question. I have 4 kids, 2 in university and 2 in high school. What would you say to them regarding this new job opportunities, and what should they do to prepare themselves to be productive in the future?
Learn Chinese and Hindi. There's some truth in that. I mean, the world is going to change, and again, it's in 1851, the U.S. was a fairly small economy. What was the biggest economy in the world? China. China was the biggest economy in the world in 1851. And they fell into a period of economic growth that was slower than ours, despite their population. Now they're catching up. So we won't be first anymore. But I think, given the fact that China and India are where the real growth is going to come, I think you really want to focus your efforts there.
Thank you very much. Dan North.
Oh, thank you.